All right, traders, it is the 5th of February, 2018. My name is Jameson. We are going to look at the S&P here. So we saw a pretty large pullback. I'm just going to do a quick public video. Let's get oriented to the chart. So this is a daily candlestick chart. There is a channel that's on here. I'm using TradingView. The TradingView indicator that I'm using, or chart attribute, is the regression trend. So this green line here is the mean. That's the average. That represents the trend. We'll just say that. And the upper trend line that I have is red, and then the lower trend line is white. That's just 2 standard deviations away from the mean with the overall trend that we have. So you can see that the SPY trend, look, it's completely intact. We do have a ton of supply, but look, we had a ton of supply here before. It was bought on the demand line. It continued higher. So at the present time, the trend's intact. I do have all these little lines that are on here. These are just Fibonacci retracements. Now, I didn't really have a clue that prices were going to drop. I use Wyckoff methodology. I look for distributive signs, for signs of buying climaxing or contracting, because actually, retrospectively, there are signs of a buying climax or irrational exuberance. The only thing that I kind of had previously shared is that it was obvious. Like, we are overbought relative to the trend. What I did share, and I shared this publicly as well, is I did share this chart, and this is a daily vertical bar chart of the S&P over the last I don't know, 13, 14 months. Not important. But what is important, we can see the fund flows here were negative for the most of 2017, and then into December and January, there was a huge increase in capital exposure here. $20 billion in December, $13.5 billion in January. This is, looking back, this is our irrational exuberance. That's our current top. And then, we obviously pull back here retrospectively. So that's the only sign that we have, is that there's a huge increase. And it also shows us that managed money or fund flows has not been a very helpful, valuable resource, because they're freaking wrong. But let's just come back here to this chart. So I might be misspeaking. Don't hold me to it, but I'm going to refer to as this larger trend here from this low. We're going to reference this low. This is February, it looks like February 10th, 2016, to our all-time high. That's going to be our primary fib. The secondary fib is this larger one I'm going to use on the outside, and these smaller ones are just going to be my tertiary fibs. Now, because there was no signs of distribution, other than being overbought from here, there was really no telling. Like, the way that I kind of got scared and closed a bunch of trades is because the market was still going up, yet my positions were losing. So all of a sudden, positions that were showed a lot of potential and some positive relative strength, they are actually like Chem, for example, they beat on their earnings and it was sold off. But many of those actually were starting to drop more while the markets was going up. So it was confusing at first. But obviously, did the right thing, closed out some trades, kind of did a little bit of over trading through there. And then as we kind of got through here, got short. So despite the markets pulling back, it was a pretty break-even day. So I managed that pretty well. But I'm referencing the fibs because when we don't have any clear signs, it does provide some good targets on where we might actually see some support and some buying. And let's just move forward. We can also see here that as we look at these tertiary fibs, that we kind of hit a period where there just was no healthy pullbacks. Not only were we overbought relative to the trend, but there really wasn't any sustained pullback where there were signs of profit taking, some buyers, and then rallying. It really got overextended, and it started here at about 250, so 249.75. I'm not calling it and saying we're dropping there, but that's where we started to overextend ourselves. So if we look here, the primary wave, or the primary fib retracement I'm looking at, we're going to reference the low here from February 10th, 2016. And here, traders are still a little indecisive. This looks very distributive, a lot of bias. The markets were seeing still undergoing some negative rotation where they're going to break down. But they kind of underwent some reabsorption. They actually rallied out. Based on the amount of time spent in consolidation through here, I've been kind of proud that I've actually, this gave us a 290 price objective. So it's pretty amazing that 290 price objective was pretty much filled on the dot, and then we puked. I don't know how that works out, but it just does. But we can see that prices rally, and then we pull back. And we can see this first pullback is still that little red. That's the, we're looking at a 38.2% retracement. And this is a 50% retracement, which, yes, I understand it's not a Fibonacci retracement, and then 61.8 that's here. So it rallied, and we didn't quite get a good pullback. It's still bullish. Traders are just, they're anxious and they're buying, and then it did break down, but it broke down in that first Fib retracement, and then it found support and rallied through there. But now this next up wave that's here, that actually did provide a pullback and traded back into that 50% retracement, which actually provides traders a lower risk entry, the buy. And then it rallied again, and as it broke down, it didn't break down into the fibs. We had another up impulse. Prices broke down and actually went from the 50 into the 61.8, and then it rallied through. Smaller wave, but we had a 61.8 retracement. Another one, this actually retraced it into the 61.8, and then this last one here actually overshot it. So at this point, supply is overcoming demand. There's some profit taken there. We can see here in the volume there actually was a little bit more selling associated with that down wave. Ultimately, though, you can see the trend remained bullish, and as it traded into the lower trend line, the demand line of this bullish ascending channel, traders thought this counter trend was an opportunity to get a lower risk entry to participate in the overall trend. They bought it, and then at that point, we kind of overextended ourselves, and there's just no retracements. We have new highs. There's really no signs of profit taking. It's just buying, no profit taking. And then we actually have another one that we can measurably pull back, and if we really look in here, there's a little lower wick here. We actually did get a 50% retracement. And then now, as soon as the markets pull back, the only thing that I provided for members is that there's some targets to look at. So we just went back to the same fibs. This is our pivot here. There's prices stalled here at this point that I have highlighted before they continued higher. So that's an important level. That might have been some preliminary supply that presented. So if that level holds, then that's very bullish. And it just happens that that level correlates with the 61.8% retracement. So that's an opportunity for prices to stall. But you can see that today's session, we obviously opened lower. We attempted the rally. We couldn't re-achieve the previous session's lows. We lost that 61.8. We probably stopped out a lot of traders. Fibonacci traders will buy that 61.8. They'll put a stop just below there, and they're looking for a retracement into the highs. So they obviously got stopped out, and as you can see now, they got stopped out of this tertiary, Fib retracement. But now, if we're looking at the August low and all-time highs, now we're looking at this secondary Fib. Prices closed today onto that 50% retracement there. So there may be an opportunity for a lower risk entry there. Otherwise, we're looking at the next one, which is the 61.8, and that's at 258.99. So that's a reasonable point. If we continue to lose those numbers, then the next ones we're looking at is at 233 and 221, and that's the overall primary retracement that we have from the previous lows that we discussed. So something to kind of watch moving forward. We're trading currently, again, into a key level that's 50% retracement. The next is the 61.8, and that's at 264 and 258. So what changes here is that we are in a bull trend, but we're in the daily trend is bearish. So we're not going to quite see dip buyers eager just yet. What's going to happen now is, here's might take a second, is that we're going to see bears take Fib retracements and try to get bearish positions with a daily trend. So if we go from here to here, oops, I got it backwards, I apologize. Here. So what's going to happen now is the dynamic changes. So we are bullish, but now the daily trend is bearish. So Fib traders, probably algos and everything else as well, if we do see a bounce, if we see a bounce into the 50 or into the 61.8 retracement, that's likely going to be sold. So we have key levels that bulls are looking at to buy, specifically this 264 and 258. That's also going to put us in this lower trend line, the demand line of this overall bullish ascending channel. But additionally, what happens is now when it bounces, we're hitting that key daily bearish retracement into 275, 277. So given the amount of supply that presented, this looks like it looks distributive, right? So for Wyckofians, this is our preliminary supply buying climax. This is our automatic reaction. Now we're looking for a secondary test, and that secondary test may be into the 78.6. but I imagine we'll hit any resistance here into this 50 and 61.8. So I think we're going to kind of be pinned laterally between the zone at 275 and then 264 or 258 here as we're trying to consolidate and trade laterally to find out who's in control. So which is going to dry up first? Is selling going to dry up, or will we rally and find out there's no demand and we'll break back down? So I may even see that there's a left shoulder here, here's a head, maybe we see a right shoulder, which would put us into further downside, which would be crazy. That would actually put us probably down into the larger term fib, which is 233. Obviously, there's a lot of speculation going on through there, but just to have some key levels to look at and trade against, bulls should be looking for an entry along the lower trend line, the demand line. That's going to put you at 258. That's going to provide a lower risk entry trading into the highs, and bears are going to sell this bounce probably around 277.95. So it's about 11 minutes. I apologize, it ran a little long. I hope you found that helpful. Good luck moving forward, traders.